I want to teach you how to read consolidation. Now, this expansion in price delivery is bullish. That's fine. You have this leg which is bullish. That's fine. And you have a level of consolidation which forms over the course of about a day and a half, closer to 2 days. There's the Asian session from Tuesday and that one from Thursday. So yeah, 2 days. This leg here is important. The high of that leg as it extends there, this will represent the high of a potential range, and that low will represent the low of the range. Using the Anvil model, when price engages an old low here, an old high with buy side liquidity, and reverses and engages an old low, you have a definable dealing range that you retroactively label a dealing range because it filled the criteria, right? The market engaged buy side liquidity and then engaged sell side liquidity, right? Marked by that low. You could even say that low, but you wouldn't need to. This would be a measure of liquidity that was engaged. So in establishing a potential breaker, what we need to do is wait for a reversal or a retracement out of that sell side liquidity. Now in the process, in the delivery of this leg here, you want to look for salient and important PD arrays. When I talk about important PD arrays, I mean potential areas, key ranges in price that algorithms should key off if is going to move in a particular direction. Therefore, the way it either respects or rejects certain important value areas determines, in my mind, the validity of a certain profile. Therefore, if price is seen to engage this range as support and not trade below its consequent encroachment, candle should not seem to close below it. In fact, after trading and closing above it, any incursion back into the value area, even with a wick, should be met with an immediate displacement higher. This would lead my bias and begin to construct, and I'll begin to construct my narrative based on those signals. I would suspect price to go higher. That expectation already is quite important, not only because I can engage with price should it be go higher, but I can also engage with the possibility, I can also engage with the scenario if price should fail in its ability to treat that level as support. As this level is continuously ignored as price begins to close below it, close above it. Well, its immediate importance as a salient level for the continuation of price diminishes, it still has a particular relevance in its ability to temper my expectation and allows me to measure the delivery of price relative to its formation. So that every time I see it lost, the more times I see it lost, the more narrative I can draw in my mind about what price is actually doing, if it's strong or if it's weak. In this case, I can make a better judgment and say that, okay, because it didn't do this one thing, now it's more likely to do the other thing, which in this case is trade lower. Anytime I see a quick displacement through the level, like I see here, I treat that as a key indicator that now price is ready to move quickly to a particular level. Generally, it's going to be some form of external range liquidity. This disregard for what would have been an otherwise important level tells me a lot about where the market wants to go. Again, I can make this measurement using a powerful concept called a extended range candle. I discussed what that is in my earlier lecture on the Anvil trading strategy, but just know it's a SIBI or BISI that has an extended body relative to its high and low. From my experience from back testing, from cataloging and forward testing, has shown to be a very telling signature left behind by the intervention of the algorithms. Again, we see its relevance as price is moved below short-term low. We have displacement in the form of a SIBI and an extended range candle. This narrative here leads me into positioning my interpretation of future price action from this point as bearish. Therefore, I'm going to be particularly interested in any time the market gaps down. Anytime it gaps down, I'm going to treat it as a bearish opportunity, as an opportunity to position myself in a short trade in the form of should price do something like a institutional order for entry drill where it just zips back into it and then trades lower, or get some form of optimal trade entry. But anytime I see this sort of price action, as candles just wick into the value area, I'm going to be interpreting all this as bullish, as bearish. The fact that candles aren't closing inside the value area, the fact that the price is wicking into it, I'm going to treat that as an opportunity in my mind. I'm going to be positioned and I'm going to be hunting the market at this point for any opportunity to sell. And therefore, if I see a setup like this, I'm already primed in my mind to take advantage of move. And quite quickly we see the result of this as price displaces quickly into a bigger sell side pull, and we actually cover this large inefficiency, and prices seem to and the market reprices all the way down into that, and that there is a good enough trade for me. The fact alone that I can take a trade like this just below, I can take it below this low, that's 17 to 20 pips quite easily, right? The fact that it's experiencing some sort of retracement here, whatever this part looks like, I haven't decided yet, but that's irrelevant because that's not the move I was hunting for. This was the move I was hunting for, and it's exactly, the market gave it to me. We were on side with the market for this portion, and that's all that matters. So that's how you can begin to read price that's how you can begin to interpret price as it forms in a range. It's very important. Things that the things that do happen are important, but the things that don't happen are equally as important. You got to always be weighing up those scenarios as they occur. So thanks for watching.